Good evening, dear students. How are you all? So, I welcome you back again to one more session, live session on capital structure, uh, wherein we are going to look at the capital structure theory part, guys, today. So, capital structure theory means we're talking of some theoretical aspects with regards to certain debate on capital structure. Okay, so what is that theory going to be? Before we touch upon the capital structure theories, what we need to look at is first, let us try to calculate certain basic numbers, right? So let's talk of how do we arrive at value of anything, right? Let's say if I want to say value of business. How do we calculate the value of a business, guys? How do we calculate value of a business? How do we calculate the value of the business? Like if I want to say that, give me the value of the assets. Give me the value of the business. So what is it going to be like? Yeah. How do we arrive at the value of a business, guys? How do we arrive at the value? Net assets. Okay. Net assets or something else. Okay. So net assets. Anything else? Anything else? How do we go about valuing a particular business? Well, always remember, guys, value of not only uh, business, we can say, value of any asset for that case, guys. Value of any asset for that case. It is simply going to be present value of all future cash flows from that asset. Present value of all future cash flows from that asset. So value of any asset is simply going to be value of any asset is simply going to be value of present value of all the future cash flows, right? Present value of all the future cash flows from that particular asset, right? So if I ask you like value of a business, value of a business, it is going to be present value of all future cash flows from the business, right? Okay. So what is the future cash flow that we get from a business? What is the future cash flow that we get from a business? What is the future cash flow that I get from the business? Yeah. What is the future cash flow that we get from a business? Profit, sales. Can I say it is present value of future earnings before interest and tax? Present value of future earning before interest and tax. Right? So present value of all future cash flows from the business is simply going to be present value of future EBITs. Right? Earnings before interest and tax, because that's the cash flow from a business. If you look at profit after tax, that's a cash flow for equity shareholder. If you look at, PBT, that's going to be before tax number, right? So what we are looking at is, as such, what's the cash flow which is being generated by the business? So when we talk of value of business, it's going to be present value of future EBITs. So present value of future EBITs is going to be the value of a business. Okay. Value of a business is going to be present value of the future EBITs, guys. Now, present value of future EBITs is what we call as the value of business. So let us say first year EBIT is EBIT 1 upon, or let me just take it as EBIT to be equal. So EBIT, this is EBIT divided by 1 plus overall cost of capital, which is for the first year. Second year, it's going to be EBIT upon 1 plus KO square, plus third year EBIT upon 1 plus KO cube. Because when I want to calculate the present value, I need to discount it at some rate. And that rate at which we are going to discount is the K over here. So this is going to continue till perpetuity, till infinity. So it's going to be EBIT upon 1 plus KO. Okay. So if you look at this particular thing, do you find this to be something like some series? Do you find it look like some series, guys? Do you feel it is a certain amount of mathematical series? Yeah. Can I say it appears to be like geometric progression? It's like geometric progression, guys. So this entire thing that we have, it's a geometric progression. Geometric progression with first term being equal to EBIT upon 1 plus KO and R is, what's the common multiple that's getting multiplied? So first term is EBIT upon 1 plus KO, and what's the term that's getting multiplied? What's the common multiple, guys, over here? 1 upon 1 plus KO. R is 1 upon 1 plus KO. Geometric progression, first term being EBIT upon 1 plus KO and R being 1 upon 1 plus KO. So now what's the formula for summation till infinity? Summation till infinity of perpetuity, it's going to be A upon 1 minus R. So A is EBIT upon 1 plus KO, the whole divided by 1 minus 1 upon 1 plus KO. So this is EBIT upon 1 plus KO, the whole thing is divided by 1 plus KO minus 1, the whole divided by 1 plus KO. So you obviously get cancelled this 1 plus KO. 1 plus KO gets cancelled, and what we are left out is just EBIT upon KO. So guys, value of the firm, value of the business entity, value of the firm is going to be equal to EBIT upon KO, which is the overall cost of capital. Same way, I can get value of equity. Can you suggest what would be the formula for value of equity? Can you just think of what should be the value of equity, guys? Formula for value of equity. What should be the formula for value of equity? Yeah. Any idea? Value of equity, guys, any idea? Well, this is going to be PAT, profit after tax, upon KE, which is cost of equity. Value of debt will be interest upon KD, which is cost of debt. So value of debt is interest upon KD. Value of equity is PAT upon KE. Value of debt is interest upon KD, right? And we can also say that value of firm is going to be equal to value of equity plus value of debt. You can also think it from this point of view. How A upon 1 minus R? Well, this is the formula itself. Summation till infinity of a geometric progression. It's A upon 1 minus R. Okay. So we have the value of firm as value of equity plus value of debt, or I can say these four are going to be the fundamental formula, guys. These four items are going to be the fundamental formula in our calculation. Okay. Yeah, guys. Fine. So now once you have understood this fundamental formula, now we are going to answer certain basic questions. I still want to look at the slide once. Okay. Yes, Pranav. Okay, fine. Now, what are we really talking of capital structure theory as? Well, capital structure theory it's going to be a debate between two set of theories, guys. It's going to be a debate between two set of theories. One is called as capital structure theory. One side we call it as theories of relevance. One side we call them as what? Theories of relevance. And on the other side, we'll call it as theories of irrelevance. Okay, so one side we have theories of relevance, other side we have theories of irrelevance. Now, when we look at theories of relevance, it is going to be basically when we say what are we meaning by the theory of relevance? The question over here that we have is will capital structure play any role? Will capital structure play any role in influencing value of company? So it's like, is the capital structure going to influence the value of the company? Or to put it other way around, we can also say, will a company with debt in its capital structure have different value as compared to debt-free company. So if you have like two similar companies, the only difference between them is the capital structure. Like one company is having debt in its capital structure, another company is a debt-free company. So are both the companies going to have different value or no? Well, if your answer is like yes, then you're talking of getting influenced by theories of relevance. And if you're saying no, that capital structure is not going to play any role in determining the value of the company, or company with debt will have different value, or company will with debt will have obviously different value, right? Then we will say you are looking at theories of irrelevance. So when we say theories of relevance, we call them as theories of relevance because you're saying that capital structure is relevant for determining the value of the company. And here we say capital structure is irrelevant for determining value of the company. Capital structure is relevant for capital is relevant for determining the value of the company, and capital structure is irrelevant for determining the value of the company. Okay, so these are like the two set of theories that we are going to look at. Now, in this, let's look at what are the theories that we have over here. The first thing that we have in the capital structure theory, guys, that is about net income approach. Then as a challenge to it, you have net operating income approach, net income approach, net operating income approach. Then we have like in the capital structure, I mean, in the theories of relevance, you have something called as traditional approach. Right. And also we have Modigliani-Miller model. But this is Modigliani-Miller model with taxes. Okay. But when you look at same Modigliani-Miller model, without taxes, then that same model is placed in the theories of irrelevance. So when Modigliani-Miller model is obtained without taxes, when you have a Modigliani-Miller model without taxes, then it is going to be classified under the theories of irrelevance. Whereas in the theories of relevance, you have Modigliani-Miller model with taxes. Okay, so these are the 5 approaches that we are going to use. These are going to be the 5 approaches that we are going to use for the discussion purpose. 3 of them are into the theories of relevance, and 2 are into the theories of irrelevance. Okay, and the basis, the logic for all their justifications and calculations are based on these formula itself. It is based on this formula itself. Okay. Got it, guys? Yeah. Okay, so let's go for net income approach. Let's go for net income approach, guys. Okay, so net income approach, guys. Now let's look at point by point. What are they targeting? Uh, first point of justification. They say that cost of debt is less than cost of equity. Do you agree with this? Yeah, guys. Do you agree with this term that your cost of debt is going to be less than cost of equity? Obviously, yes. Since debenture holders, take lower risk than equity shareholder, of course, their rate of return is going to be less than the return that is required or that is asked by the equity shareholders. Okay. Second point, cost of debt is less than cost of equity. That's okay. But then the second point now, they say as weightage of debt increases, overall cost of capital decreases. So as weightage of debt increases, overall cost of capital, which is KO, it decreases. Okay. So let's take an example. Let's look at the numbers example to understand this. Let's say we have amount of equity, amount of debt. Then we can definitely say weight of debt, weight of equity, weight of debt, cost of equity, cost of debt, and then the overall cost of capital KO, which is weight of equity into cost of equity plus weight of debt into cost of debt. Okay. So we have this particular numbers. Amount of equity, WD means weight of debt, guys. Weightage of debt. So equity, debt, weight of equity, weight of debt, cost of equity, cost of debt, and then we have the overall cost of capital. So equity is, let's say if your equity investment is 10,000 and there's no debt, what will be the weight of equity? 1. Weight of debt will be 0. Let's say cost of capital, overall cost of capital is 15% and cost of debt is 10%, guys. Then can we calculate the overall cost of capital, guys? Of course, overall cost of capital is going to be 15%. Overall cost of capital is going to be 15%, guys. Then let's say you bring in 1,000 of debt by replacing an amount from equity. So you bring equity to 9,000 and debt of 1,000. Weightage of debt is going to be weightage of equity will now become 0.9 and weightage of debt will become 0.1. So cost of equity is 15 and 10%. Let us say we bring it to a stage where it is 5,000, where it is maybe 2,000 and 8,000. So this is a weightage of 0.5, 0.5. Here the weightage is 0.2, 0.8. And then we have 15%, 10%. Okay. Calculate the overall cost of capital KO, guys. Calculate the overall cost of capital. Calculate the overall cost of capital KO. For all the three cases, get the overall cost of capital for me, guys. Okay, so second line item, it is 14.5%. What about the third case? In the third case, what's the overall cost of capital? Okay. So next it is what? 12.5%. Fine. What about the last case? Last one. What is it? 15 into 3 and then 8. So it's 11%. So what do we observe over here? What do we observe over here, guys? As the weightage of debt increases, what happens to overall cost of capital KO? Yeah. What happens to the overall cost of capital? Can I say overall cost of capital is reducing? So as weightage of debt increases, weightage of debt increases, the overall cost of capital is reducing. Okay. And then they say in the third stage, as weightage of debt increases, KO reduces, value of business reduces. Value of business reduces. So let us say KO part. So KO is like we start with what? 15%, 14.5%. Then it is what? 12.5. And then they say 11%. Okay. So this is KO. And then we get the value of the firm. Now, value of the firm is going to be EBIT upon KO. Now, if I tell you, let's say the EBIT value is 15,000, or maybe let's say the EBIT value is wait, let's say the EBIT value is 1,000. So it's 1,000 divided by KO. Just give me the KO numbers, guys. Just give me the KO numbers. Give me the KO numbers. Sorry, not KO, but my bad. Value of the firm numbers, guys. What's the value of the firm in the first case? So if our EBIT is 1,000, and we divide 1000 by KO, what is the value that we have? Hmm? Okay, so first case it is what? 66,667. Then second case 6896. Okay, third case 8,000. Okay, and then fourth case 9,090. So over here, what we observe is as KO is reducing, what is happening to the value of the firm? Value of the business, can I say it increases? Right, so value of business increases, guys. So as a conclusion, can we say as weightage of debt increases, your overall cost of capital reduces, leading to increase in the value of the firm. So what do we conclude? Is the capital structure basically your proportion of debt? Is it determining the amount by which the value of firm is going to change? Is it going to determine the amount by which the value of the firm is going to change? Yes, so value weightage of debt increases, KO is going to reduce, the value of the firm is also going to increase, guys. Right? Right? Other things remaining same, of course. So is it like a theory of relevance? Yes. So we can say the value of the company is getting affected by the amount of debt that you have taken. Value of the company is getting affected by the amount of debt that you have taken. And that's what the conclusion of net income approach is. Now to challenge this, we had something called as now net operating income approach. Now, in this net operating income approach, they also agree with the first point that cost of debt is less than cost of equity. Okay. But when they go to the second point, they find something problematic with this table. Anything problematic or anything wrong do you find in this table? Not from the point of view of calculation, but from a logical inference point of view, do you find some problem over here? Do you find some amount of problem in this table, guys? Do you find some problem in this table, guys? Any problem? Preference share capital? No, not with regards to the preference share capital, but some logical, something which is missed out in this model. With increase in debt, no change in equity return expectation. Yes, absolutely correct. Was it Kuldeep? Yeah, absolutely correct, Kuldeep. Because where you look at this, that as your weightage of debt is increasing, as the weightage of debt, it increases. So you see that the weightage of debt increases. What is it? Something that's happening different, right? As the weightage of debt increases, can I say risk for the equity shareholders also increases? Risk for equity shareholders also increases. And if the risk for equity shareholders are increasing, are they going to be asking for the same 15% rate of return, guys? Are the equity shareholders asking for the same 15% return, or will they be asking for a higher rate of return? Or will they be asking for a higher rate of return? Okay. So that is what the point, second point in net operating income says. It says that as weightage of debt increases, as weightage of debt increases, overall cost of capital decreases. But there is a side effect coming in from weightage of debt increasing, and that side effect is KE also increases. So as we find that weightage of debt is increasing, overall cost of capital is decreasing. As we find weightage of debt increasing, we find that the overall cost of capital is decreasing, and KE is also increasing. So as weightage of debt increases, KO decreases, KE is increasing, KE is increasing. So what is going to happen if the KE increases? Can I say KO is also going to increase? So one effect we definitely say, as you are giving more weightage to the debt because it is having a lower cost, the KO is going to decrease. But the side effect is that expectation of equity shareholders is going to increase due to higher risk, right? So due to higher risk, they are going to ask for a higher rate of return, and then you have the KO also increasing. So both of them, KO on one side there is a decrease in KO, and on the other side there is an increase in KO. So what will be the resultant impact of both these factors? What is the resultant impact? They say that debentures is pulling it down, equity shareholders is pulling it up. So the net effect is going to be that KO will remain constant. KO will remain constant. Clear, guys? So one thing that was missed out in net income approach was that as the weightage of debt increases, KO is definitely decreasing, but there was a side effect which was happening, and that side effect was with regards to the cost of equity. That side effect was with regards to cost of equity. So cost of equity, as the cost of equity increases due to higher risk, KO is also going to increase, right? So KO is also going to increase, and as the KO increases, you will find that both of them, the decrease in KO and increase in KO is going to offset each other. That's going to offset each other, and when it offsets each other, KO is going to remain constant. Okay, guys, clear? Yeah. So now, a question to you guys. Let me just take this same data. Let's remove the first line item from this. Okay, so we have 14.5%. Now, as the model says that even if you bring in more amount of debt into your business, the overall cost of capital, which is KO, as weight of equity into cost of equity plus weight of debt into cost of debt, that should remain 14.5%. So we know that as per the net operating income approach, the overall cost of capital should remain stagnant at 14.5%. The overall cost of capital should remain stagnant at 14.5%. So now the question is, give me the value of KE, guys. What is the value of KE? What is the value of KE, guys? You have to find the value of KE so that your overall cost of capital remains same at 14.5%. Try to calculate it, guys. Calculate the value of KE, guys. Your KE should be such that overall cost of capital should be 14.5%. Yeah. So over here, the first case it is 19%. Okay. What about the second case? What's the value, guys? 32.5. So can you observe one thing? One thing that we can observe is the KE is increasing with the increase in weightage of debt. That's obviously because of the higher risk. Right? That's because of obviously the higher amount of risk, right? So that's your net operating income approach, wherein we say that the value of KO is remaining constant. So of course, the third point, as KO is constant, value of firm will also be constant. As KO is constant, value of firm will also be constant. Right? So as your KO, overall cost of capital is constant, the value of firm is also going to be constant, guys. Okay, so that's your net operating income approach. Now, there is some problem with this particular schedule also. Can you identify what is that problem? Can you identify what is that problem, guys? There is something which is missing in this particular table also. Can you just think of what is that problem? Yeah, guys. Do you think any amount of loan that you take, from a bank is going to provide you at the same 10% rate? You borrow 2 lakh, or you borrow 200 lakh, or you borrow maybe 20 crores. Do you think banker is going to charge you the same rate of interest? Is the banker going to charge a same rate of interest or higher rate? Of course, higher rate will be charged to you, right? So of course, a higher rate will be charged to you for a simple reason, guys. The rate of interest will be higher because the risk for the banker also increases, right? Because the risk for the banker is also going to increase. So as the KO is constant, value of the firm is also going to be constant. That was happening because you said that the cost of debt was remaining same. So now that is something which was removed by this traditional approach. Now in this traditional approach, what happens is the cost of equity and cost of debt are going to vary with regards to weightage of debt. As the weightage of debt increases, we find that cost of equity is definitely going to increase. right? As the weightage of debt increases, cost of equity is also going to increase. And cost of debt also is going to be constant for certain time period only. And beyond that value, even the cost of debt is going to increase, guys. Right? Because after a point of time, the bankers will also start feeling the risk, and they will say, now, if you want a higher amount, you need to pay for a higher rate of interest. Now, what's going to happen with the overall cost of capital? So, the overall cost of capital, initially, there is some fall, right? And then after that, a point of time, it again starts rising because there is an increase in KE and also there is an increase in KD. So it's like your overall cost of capital. Okay, so the overall cost of capital is going to be dependent on the relative numbers of cost of equity and cost of debt and weightage, right? So as the weightage of debt changes, the value of cost of equity, cost of debt is changing, and definitely overall cost of capital is also changing. So the optimal capital structure is going to be at this particular level where the KO is minimum. Okay, so the optimum capital structure is going to be that level wherein where the cost of capital, I mean weightage of the optimum level of weightage is going to be that level at which the overall cost of capital KO is going to be the minimum one. Okay, so how do we go about raising capital, guys? We should raise the capital in that proportion which results in results in the lowest cost of capital, because lowest cost of capital will ensure highest value of the firm. Lowest cost of capital will result in higher value of the firm. Got it, guys? This is your traditional approach. Yeah. So it combines both. Actually, it combines the net income as well as net operating income approach. And in this particular traditional approach, and in fact, net operating income and net income approach, we didn't give any consideration for the taxation part, guys. Right? So we're going to look at the fourth approach, which is called as the Modigliani-Miller model with tax. In fact, this is just a revised version of net operating income with tax. So Modigliani-Miller model is simply going to be the NOI, net operating income approach with tax. Right? Modigliani-Miller model with tax, NOI with tax. Okay, so Modigliani-Miller model with tax, which is NOI with tax. That's the thing that we are going to look at. The model with tax, how is it going to be different? You know what? Without tax, they already said that value of a company with debt is going to be same as value of company without debt. So without tax, value of a company with debt is going to be same as the value of the company without debt, right? Or we call it as value of a levered firm will be same as the value of unlevered firm, because you take debt or you don't take debt, it doesn't matter, because your overall cost of capital remains same. That was already what we have concluded in the net operating income. But when you have taxation in the picture, which company actually stands to gain due to tax? The company with debt or company without debt? Which company is having an advantage when you have tax structure, when you have tax payable, when you have an amount of tax payable, which company do you feel is having an advantage? The levered company, I mean the company with debt or the company without debt? Of course, the company with debt. So when you have a company with debt, now why? Well, there is some relation over here. I'll come to that relation at a later point of time. A company with debt will have lower tax due to interest payment. So as you're paying interest, you're going to pay lesser tax. As you're paying interest, you're going to pay lesser tax. So a company with debt will have lower tax due to interest payment, or we can say tax savings for a company with debt. Tax savings for a company with debt. So how do we go about calculating this tax saving for a company with debt? Can I say whatever amount of tax you pay or whatever amount of interest you pay, on that tax is going to be saved. Like if you're paying, let's say for example, 10,000 interest, and let's say tax rate is 30%. So tax savings, so savings in tax is going to be this 10,000 multiplied by 30%, because you're paying 10,000 as the interest, right? On that 30% tax is what you're going to save. So savings in tax is going to be 10,000 into 30%, which is 3,000. Now this savings in tax, is it going to happen every time forever? This amount of savings in tax, is it going to happen every time forever, guys? Do you feel that this savings in tax is going to be there with you every time forever? Of course, yes. Because if you assume that the company is going to continue till perpetuity and EBIT and all numbers are going to be there, so savings in tax is going to be like 10,000 into 30%, which is 3,000. Right? So 10,000, 30%, until debt is there, you will have 3,000 savings in tax. So if I say, what is the present value of all future tax savings? Right? Present value of all future tax savings. Like this is your first year tax saving, interest into T. Let us discount it by a year. So this is 1 plus KD. Then tax saving in the second year, it's going to be interest into T upon 1 plus KD square plus interest into T upon 1 plus KD cube. And this goes on till perpetuity. Now from this, of course, I can take out the interest part. And what I have is interest upon 1 plus KD plus interest upon 1 plus KD square plus interest upon 1 plus KD cube, and this goes on till perpetuity, guys. So this is T into, now this interest upon 1 plus KD plus interest upon 1 plus KD square plus interest upon 1 plus KD cube. This is nothing but, guys, value of debt. Because it's the present value of all the future interest payment. The present value of all future interest payment is nothing but the debt itself. Right? So this is tax into value of debt. So when we say value of the levered firm, it's going to be equal to value of unlevered firm plus present value of future tax savings due to interest. And that is nothing but value of unlevered plus value of debt into tax rate. So this was the formula that I was talking of. Value of levered will be equal to value of unlevered plus additionally debt multiplied by tax rate will be added to arrive at the value of the firm. Okay. Did we get this formula, guys? So if it is no tax, value of levered and unlevered are one and the same. If you have taxation, then value of levered will be equal to value of unlevered plus amount of debt into tax rate. Okay. Last part. Well, the value of the levered firm will be equal to unlevered. But what is the additional thing that the levered firm is getting? It is getting the savings due to the tax saving on the interest. So the present value of all the future tax that you will be saving, that is computed over here, right? We took the present value of all the future tax saving. That's going to value of the debt into the tax rate. This is the derived number. Got it, Asta? So levered firm is going to have an additional value because of the future tax savings. Because of the future tax saving, this levered firm is going to have an additional value. Right? And this is what we call it as a model with taxes. Okay, so VD, value of debt for perpetuity, has to be asset. So value of debt is what we have, right? That will be given to us. Okay, fine. So these are the theories that we have done. Now we have to do certain set of questions, guys, right, for this particular 4 theories. So we'll start with the questions after a break, right? So let's take a break right now of around 15 minutes, and then we'll come back and get started with the questions based on these theories, guys. Okay, so let's just take a break, guys. Let's take a break of 15 minutes, guys. Okay, let us continue, guys. Okay, so now let's look at some practical problems for the cost of another capital structure. Just wait, let me just open up the file. This is the capital structure theory. Let me open it. Okay, so here we go with this question, guys. Okay. Okay. So coming to the first question. So we have Lakshmi Limited, which is expecting an annual earnings before interest and tax of rupees 2 lakhs. Okay. So we have a EBIT, earnings before payment of interest and tax, which is EBIT. This one. Hmm. So we have the EBIT number, earnings before interest and tax, to be equal to 2 lakhs, guys. So EBIT is 2 lakh. The company in its capital structure has rupees 8 lakh in debentures. So basically value of debt is 8 lakhs. Okay. Then cost of debt is going to be 10% because the question says that it is 10% debentures. Cost of equity or capitalization rate is 12.5%. So we have cost of equity as 12.5%. You're required to calculate the value of the firm according to NI approach and also calculate the overall cost of capital. So first up, we have to get the value of the firm. Value of the firm will be, there are two formulas. One is EBIT upon KO, or the other is to get value of debt plus value of equity. Now, out of these two formula, which one seems feasible for this question, guys? Which one seems feasible for this question, guys? Yeah? Which one seems feasible for you? Value of debt plus value of equity, right? Because if you're looking for this calculation, I need KO, but there's no way I can get KO because I need the weightage of debt, weightage of equity. So of course, this seems to be accurate because value of debt is already given to us. But we can get the value of equity as, we can get the value of equity as PAT upon KE. We can calculate PAT from EBIT and we also have the KE. So let's start with EBIT number. EBIT is 2 lakh. From that, we are going to subtract interest. So interest is going to be like 8 lakh into 10%. All right. So interest is going to be what? 80,000. And then we have profit before tax. So we have profit before tax available. The profit before tax is 1,20,000. So since there's no tax, your PBT and PAT are one and the same. From this, I can get the value of equity as PAT upon KE, which is 1,20,000 upon K is 12.5%. So PAT upon KE, which is 1,20,000 divided by KE. Set of edges. So value of equity is how much, guys? So 1,20,000 divided by 12.5%. 9,60,000, right? So obviously the value of firm can be obtained as value of equity plus value of debt. So value of equity is what? 9,60,000 plus value of debt is 8 lakh. So the value of firm will be calculated as 17,60,000. We also want to know the calculation of cost of equity. We want to know the cost of equity, cost of overall cost of capital. So we can get the KO since we know that there's a formula for value of firm is EBIT upon KO. This implies that KO is equal to EBIT upon value of firm. So therefore, KO is going to be EBIT is 2 lakh upon value of firm is 17,60,000, guys. So what's the overall cost of capital KO, guys? What's the overall cost of capital KO? 2 lakh divided by 17,60,000. 2 lakh divided by 17. It's 11.36%. Okay. 11.36%. That's the answer for the first question, guys. Right? Now, give it a try. The second one, guys. Try out the second question. Because now in the second question, they're saying the value of debt increases further by 2 lakhs. So instead of taking the value of debt as 8 lakh, you have to take the value of debt as 10 lakh and redo the calculation. Can you do this question too? Can you calculate this question number 2, guys? Yeah. Yes. Okay. Go ahead, guys. Try to solve this question number 2. Okay, done? Fine. So this entire calculation we can just carry out by changing the numbers. So now EBIT remains the same. The only change that we have is value of debt becomes 10 lakh. So even the interest gets subtracted at 10%, which is 1 lakh. So this PBT or PAT is now 1 lakh. So PAT is going to be what? 1 lakh divided by 12.5. So value of equity is coming out to be how much, guys? 1 lakh divided by 12.5. Value of equity is how much? What's the value of equity? 8 lakhs. Okay, so this is going to be 8 lakh plus 8 lakh. So value of firm is 16 lakhs. So value of firm will be EBIT upon KO. So of course, this is going to be now the overall cost of capital is going to be 2 lakh divided by value of firm, which is 16 lakhs. So 2 lakh divided by 16 lakh. Sorry, 8 lakh plus 10 lakh. My bad. So this is going to be 18 lakhs. So 2 lakh divided by 18 lakh. So value of overall cost of capital is 11.11%. Perfect. Correct, guys. Very true. Now, let us look at question number 3. So Modern Limited is expecting an earnings before interest and tax of 4 lakh and it belongs to a risk class. KO is 10%. You are required to find out the value of the firm cost of equity capital if it employs 8% debt to the extent of 20%, 35%, 50% of the total financial requirement of 20 lakhs. So we have like 3 situations provided over here with regards to value of debt. Value of debt. In first case, it's going to be 20% of 20 lakh, which is 4 lakh. 35% of 20 lakh, which is 7 lakh, and 50% of 20 lakh, which is 10 lakh, is the value of debt. And we have the cost of debt given to us to be 8%. Cost of debt is 8%. Value of debt is 4 lakh, 7 lakh, and 10 lakh, depending on the situations, depending on the scenario. And then we have the cost of debt as 8% given to us. We have the EBIT number. EBIT is like 4 lakh when whatever amount of money you raise by way of debt or whatever amount of money you raise by way of equity, your EBIT stands as 4 lakh. EBIT is so EBIT is going to be 4 lakh, guys, right? So I've got the EBIT to be 4 lakh. Now, based on this, we have to calculate the value of the firm, cost of equity capital. Right. So first up, how do we approach this question? I'll just give you an outline of how to solve the question. Then will you be able to calculate the numbers? Yes, guys, can you calculate? I'll just give you an outline. So from EBIT, you will subtract interest, which will give you PBT. And in fact, this itself is your PAT because there's no tax rate given to us. You get the PAT, right? Then the question says that you have a overall class of capital as 10%. Overall class of capital as 10%. So you get the value of firm by simply doing EBIT upon KO, which is nothing but EBIT upon 10%. KO is 10%. Okay. You got the value of firm. From that, you're going to subtract the value of debt, which will give you value of equity. Further, KE, cost of equity, will be calculated as, PAT upon value of equity. In fact, this is what we need to calculate, right? You want to calculate the value of the firm, that is done. Cost of equity capital, that's calculated over here. So will you be able to complete this table, guys? Will you be able to complete this table? Yeah. Okay. Great. Go ahead, guys. Complete this table. Okay. So the interest that will be subtracted is 8% of 4 lakh, which is 32,000. In second case, it is 56,000. And in third case, it is 80,000, right? So here the PBT has what? 3,68,000, 3,44,000, and 3,20,000. So value of the firm, which is EBIT upon KO, value of the firm, EBIT upon KO, which is 10%. EBIT is 4 lakh divided by 10%. In fact, in all the cases, value of the firm is going to be 40 lakhs, right? Value of debt is going to be like 4 lakh in first case, 7 lakh in second case, and third case it is 10 lakh. So we get the value of equity, guys. So value of equity is what? 36 lakh, 33 lakhs, 30 lakhs. So K is going to be 36, 3 lakh 68 upon 36 lakh. So that is 3 lakh 68,000 divided by 36 lakh, which is 10.22%. Then next it is 3 lakh 44,000 divided by 33 lakh. That's 10.42%. And 3 lakh 20,000 divided by 30 lakhs, which is 10.67%, right? Okay, so that's your cost of equity, guys. Cost of equity 10.22, 10.42, and 10.67%. Got it, everyone? Okay, so that's your question number 3. Now let's look at question number 4, guys. How 40 lakh arrived? It's EBIT, right? I mean, EBIT of 4 lakh divided by 10%. Kuldeep, is it fine? EBIT divided by 10%. Okay, question number 4, guys. Ganesh Limited is expecting an EBIT of 3 lakh. Company presently raised its entire fund requirement of 20 lakh by issue of equity at a capitalization rate of 16%. The firm is now contemplating to redeem a part of capital by introducing debt financing. The firm has 2 options: to raise debt to the extent of 30% or 50%. So basically, value of debt can be 6 lakh or it can be 10 lakh. It is expected that for the debt financing up to 30%, rate of interest will be 10%, and equity capitalization is expected to increase to 17%. However, if the firm opts for 50% debt, the interest rate will be 12% and equity capitalization will be 20%. You're required to compute the value of the firm from its overall cost of capital from different options. Okay, so again, I'll just give the outline for this, and will you be able to solve it? Yeah, same way. I'll give you the outline, right? So we have like 3 situations. One is current, and second is 30% debt and 50% debt. Fourth, so 30% debt, and we have 50% debt. So current level, then we have 30% debt and 50% debt. So we have the value of debt. Current level, there is nothing. But if you look at the 30% debt, it's going to be 30% of 20 lakh, which is 6 lakh, guys. And this is going to be 10 lakh. Okay, so we have the value of debt. Then the firm has 2 options to raise, either over here, and then we have the EBIT numbers. Well, the EBITs are given to us 3 lakh. So whatever be the amount of debt you raise, your EBIT is going to be 3 lakh. Okay, then we have the cost of debt. In fact, wait, I'll remove this EBIT. Yeah, cost of debt is given when over here it's not applicable, but when there is a 30% debt, rate of interest or cost of debt is 10%, and cost of equity is going to be like 17%. And current capitalization is, let's say, 16%. 50% debt, it says that the interest rate will be 12% and capitalization rate will be 20%. Okay, so we have the EBIT numbers. From that, we will subtract the interest, which will give you PBT, right? You simply divide this by K, which will give you value of equity. You will get the value of firm as value of equity plus value of debt. And then finally, KO will be EBIT upon value of firm. So can you calculate this? Where numbers, guys? You can calculate these numbers, everyone? Yeah? Sure. Do it, guys, quickly. Okay. So the interest part, it's going to be nothing over here. Over here, the interest is what, 60,000. In the second case, interest is 1,20,000. So PBT is 2,40,000. And this is what, 1,80,000. So divided by cost of equity, which is 16%, 17%, and 20%. So value of equity. So we can get the value of equity as 3 lakh divided by 16%. That's 18,75,000. So value of equity right now it is 18,75,000. Then this is 2,40,000 divided by 17%, which is what, 14,11,764 or 765. Then it is 1,80,000 divided by 20%. That's going to be 9 lakh. And then value of firm will be 18,75,000 in first case. Then the second case, it's going to be 20,11,765, and last case it's going to be 19 lakh. So overall cost of capital here it is 16%. Second case it is going to be 2,40,000. Sorry, EBIT is 3 lakh. 3 lakh divided by 20,11,765. 14.91%, and this is 3 lakh divided by 19 lakh. 15.79%. So that's your overall cost of capital, 15.79%. Got it, everyone? These are the numbers. You got it? Overall cost of capital. Okay, perfect. So that's question number 4. Now, let us take up question 7 over here. Question number 7. We have RES Limited is an all equity finance company with a market value of 25 lakhs and its cost of equity is 21 lakhs. So company wants to buy back equity share worth 5 lakh by issuing and raising 15% perpetual debt. So we're going to raise this 5 lakh by issuing 15% perpetual debt of the same amount. The rate of tax may be taken as 30%. After the capital restructuring and applying the model with the taxes, you're required to calculate what will be the market value of RES Limited, cost of equity, and weighted average cost of capital. And then obviously we have to comment on that part also. Okay, this is an all equity finance company with a market value of 25 lakhs. So we have like a phase where we are unlevered, wherein we don't have any debt. Second is a stage of levered. Okay. So when it comes to levered or unlevered, we have a cost of equity given to us to be 21 lakh. So we have the value of equity as 25 lakh. We don't know what's the value of the equity of the levered one, right? Value of debt, it's nil over here. But when you are going for levered, you're raising 5 lakh by way of debt, right? So then we have, of course, the value of firm over here to be 25 lakh. Now, again, don't know what's the value of the firm. But the next thing that we have is market value is something, and then things are given. If you want to know value of the levered entity, guys, can we get the value of the firm here? Remember the Modigliani-Miller with taxes approach, model with the taxes approach? Do you remember it, guys? Model with the taxes. What was the formula? Model with taxes. What was the formula, guys? Value of unlevered plus debt into tax, right? So can I say over here, value of firm over here is going to value of unlevered plus the value of debt into tax rate. So which is essentially going to be like 25 lakh plus 5 lakh into tax rate. And what's the tax rate given in the question, guys? Tax rate is 30%. So we just multiply this 5 lakh with 30%. So 25 lakh plus 5 lakh into 30%. So what's the value of the firm when it comes to levered entity? Can we get the value of the firm levered, guys? Yeah, 26 lakh 50,000. Perfect. So now we have to do a bit of reverse calculation over here because we have KE. We have KE, which is belonging to the unlevered category. That's 21%. We don't know what is KE over here. Cost of debt. Over here, it is not applicable. What will be the cost of debt in case of levered, guys? In case of levered entity, what will be the cost of debt? Like perpetual debt of the same one, but 15% is the rate. But mind you, you can't take 15% as cost of debt because it's going to be 15% before tax, right? But now the tax rate is applicable. So even the cost of debt needs to be adjusted. So cost of debt is going to be 15% into 1 minus 0.3, which is after tax number. So what will be the cost of debt, guys? 10.5%, right? Okay, so we got the cost of debt as 10.5%. Now, rate of tax is obviously 30%. We have to calculate, but we've got the market value of RES Limited. Now, since we have the KE number over here, I can definitely get the PAT. Profit after tax number will be KE multiplied by value of equity. Here we can't get this because we don't know what is KE, neither we know what's the value of equity. We can't calculate that. Obviously, we can arrive at, after PAT, we can arrive at PBT by simply saying that it's going to be like adding back the tax will give us PBT. Then adding back the interest will give us EBIT. Now, of course, interest is not applicable over here. This is also going to be not applicable. This is also not applicable. This is also not applicable. Not applicable for EBIT. But yeah, once we get the EBIT, we can definitely say whatever EBIT is over here, that same EBIT is going to be over here. And then let's do the reverse calculation with regards to less interest, which will give us PBT, less tax, which will give us PAT. Right? And once we are arrived at PAT, I mean, this entire portion is not required to be computed, guys, because that's already taken care over here. You arrive at profit after tax, and we can get the value of equity also. Value of equity. This is going to be calculated. Value of equity will be value of firm minus value of debt. And then KE, overall, I mean, the cost of equity can be computed as, guys, PAT upon value of equity, which you have to get it over here. So can you just try to fill up these boxes? Let me just tell you which are the boxes that you're required to fill. This one, this one, this one, and then of course all these boxes. Can you fill these boxes, guys? Yeah. How do we know whether it is 15%? Because the question says, right, raising 15% perpetual debt. So 15% is the rate of interest. Okay, and the rate of interest is obviously before tax number. So try to fill up these numbers, guys. Try to fill up these numbers. Okay, so we have what? That is K into value of equity. Value of equity into K, which is 25 lakh into 21%. So 25 lakh into 21%. This is what? 5 lakh 25,000. So just do the reverse calculation. This divided by 0.7 or 5 lakh 25,000 divided by 0.7 we can do. We get the PBT as what? 7 lakh 50. PBT is 7 lakh 50,000. No interest is applicable. So EBIT itself is now 7 lakh 50,000. Now, of course, I can just copy this 7 lakh 50,000 over here. Now, the interest is going to be 15% of value of debt, which is 5 lakh. So 5 lakh into 15%, 5 lakh into 15% is going to be what? 75,000 as the interest. So PBT will be 7 lakh 50 minus 75,000, which is 6 lakh 75,000. And then we have a tax. Tax is 6 lakh 75,000 into 30 divided by 100, which is 2 lakh 2,400. 2 lakh 2,500. So we get a PAT as this minus 6 lakh 75,000, which is 4 lakh 72,500, right? Value of equity will be, of course, value of firm minus value of debt. So it is value of firm is 26 lakh 50 minus the value of debt, which is 5 lakh. So value of equity will be 21 lakh 50,000. So K is going to be 4 lakh 72,500 divided by 21 lakh 50,000, which is 21.98%, guys. Did you get this K as 21.98? Yes. Okay. One more thing that we need to compute here is what's the weighted average cost of capital? So how do we calculate the weighted average cost of capital now? Well, KO can be computed as weight of debt into cost of debt plus weight of equity into cost of equity. So we'll write down like the capital, amount, weights, cost, and then we'll simply do weights into cost. So in capital, we have equity, we have debt. Value of equity is what we have got right now, which is 21 lakh 50,000. Value of debt is it was 5 lakhs. Sorry. Right, so total value was coming out to be 26 lakh 50,000. And we know the cost of equity, guys. Cost of equity is 21.98% and cost of debt was 10.5%. Can you just do the calculation of cost of capital, guys, by calculating the weights, multiplying weights with the cost, and then taking the total? Can we do it? No, guys. Just calculate the weights into cost, guys, and give me the weighted average cost. Okay. Let's talk about the weights. So weights are what? 21,50,000 divided by 26,50,000. 0.8113. And this is 5 lakh divided by 26,50,000, which is 0.1887, totaling to 1. Then we take the weighted average cost, which is simply 0.8113 multiplied by 21.98, which is 17.8324. And the other is 10.5 into 0.1887, which is 19.813. Once again, 1887 into 10.5. Okay, so that's 1.9813. And if I just add them both, it is 17.8324 plus 1.9813, which is 19.8137. So that is 19.8137 weights into cost. 19.81, did you all get it? Yes. Well, we can get this weighted average cost of capital by using another method also. We know value of the firm. You know the value of the firm, guys. This is generally EBIT upon KO. Generally EBIT upon KO. EBIT upon KO, right? Value of firm is EBIT upon KO. But if this is if without tax, if we have taxation, if tax is applicable, then value of the firm will be EBIT into 1 minus T upon KO. Okay. So we can get KO as EBIT into 1 minus T upon value of firm. So over here we can say, what was the EBIT number? 7,50,000. So this is 7,50,000 into 1 minus 0.3 upon value of the firm that we have arrived is 26,50,000. So this is going to be 7,50,000 into 0.7 divided by 26,50,000, which is, again, you can see it is 19.81%. Right? So either of the ways, you can simply take the weighted average number, or you can use this formula of EBIT into 1 minus T divided by value of firm also. Okay. Are we clear, guys? How do we get the cost of equity? Yeah. Are we clear? How to calculate the cost of equity? Okay. By the way, this chapter is, guys, not yet complete, because we still have to look at something called as arbitrage model, Modigliani-Miller arbitrage model. So next class which we have, probably on Wednesday, not on Wednesday, sorry. Today's Tuesday, Thursday, holiday. When we have it on Friday, Saturday, we will discuss initial probably initial around an hour before the break, we'll discuss about this topic. Post break, we'll start with the next topic of leverages. Okay. Can you say what do we have to interpret? Well, interpretation is nothing. It's just that both ways your overall cost of capital is going to remain same. Yes, Asta.
Sir, sir, in last topic of chapter 4 of marginal cost of capital, sir, in that B part, we have taken the cost of new debt or the new preference shares, even if we are not issuing the new shares.
Cost of
We
new.
have taken the values of as per A part in B part also, but we are not issuing any new shares.
But we are issuing new shares, right?
We are not issuing new shares in B part, and we are required to calculate the marginal cost of capital when no new shares are issued.
The marginal cost of capital when no new shares are issued. So of course you will be utilizing your reserves, right? And your cost of reserves and cost of equity will remain same.
Sir, but in that we have calculated like a weighted average cost of capital, and we have used the
weighted average
cost of A part.
We are using the reserves, right? We are using the reserves, correct?
But here, sir, we have using the no, sir, we have not using the reserves. It is like originally what we have to be the cost. Originally, we have some capital structure in that.
Which question you're talking of?
Marginal cost of capital, last illustration.
You're talking from the module?
Yes, sir.
The module, then that's a different question. And what I haven't covered in such. So there, it is like if you don't want to issue any shares, but in that question, you're supposed to be like, what is the first statement of that question? Look at the first line of the question. Read the first line of the question.
So question has the following capital structure already.
No.
14% debentures, preference and equity shares.
Read the first statement of the question. First line of the question. First line of the question.
Calculate after tax cost of new debt.
No. First line of
the question.
Starting line of the question. What is the starting line?
ABC Limited has the following capital structure, which is considered to be optimum as on 31st March.
Wait. Which is considered to be optimum. So when you say optimum, you have got some structure. You have got a proportion of equity and debt you need to maintain. Okay, so if you are not issuing any equity shares, you will use the reserves which you have generated in the previous years. So those reserves are belonging to the equity shareholders, and therefore we take the cost of equity for that case. Okay, since the capital structure is supposed to be optimum, so you will have to maintain that debt, equity and preference share proportion. So even if you don't issue equity shares, you will have to use the reserves for computing. So
in that case, that will have the same cost.
Same cost as equity, yes.
Okay, sir. So preference shares also have the same cost then?
Yes.
It is also same cost, isn't it?
Yeah.
Okay, sir. Okay. Sir, in market value weights, you have told that retained earnings will be taken as nil.
Yeah.
As not applicable to that. But in all our module questions, it is taken as equal to the cost of equity, or it's just added to the equity.
No. If market value, when you want to compute the weights of market value, then you don't have the market value separately for the reserves, right? The value of the reserves is clubbed into the value of equity shares. Value of
reserve. Here we. Yes, sir.
Value of reserves is clubbed along with the value of equity. Cost of equity and cost of reserves will remain same.
So here the total market value is there and it is divided in the proportion of book value. Sir, it is written in theory also.
That's okay. Your answer is going to remain same because you're taking the cost as same. Unless and until your cost is different, it won't matter.
Cost is same. Equity shares and retained earnings will always remain same.
Yeah, their cost of capital is same, right? Cost of equity, cost of reserves are equal.
Sir, but if they are different, like flotation cost, we don't take in retained earnings. So then they both are different.
Then you divide it proportionately in the ratio of book value. If you are having a different cost, then
it will not make any difference.
Then you can simply
So even if they are having the different cost or having the same cost, we have to divide it in the book value ratio.
No. If the cost is same, then no need to divide it. If the cost is different, then you will have to divide it.
Sir, if the cost is same, then we will add in equity share plus retained earnings and total market value.
Yeah, correct. Correct.
Okay. So can we divide it also?
Yeah, you can. You can divide it. There's no problem in that.
Answer not remain changed.
Yeah.
Okay, sir.
Okay.
Thank you, sir.
So let's just stop here, guys. See you in the next class. Bye bye, guys. Take care. Done.